With Som Seif, the CEO of Purpose Investments, which launched a U.S. dividend ETF today. We'll talk about that in a second and your view on U.S. equity markets. But let's talk OPEC, the big meeting on Thursday. Is OPEC's credibility at risk if they don't cut production, and also the optics of them being unified?
Well, I actually think that if they don't do anything, maybe a little bit of, question mark as to whether or not OPEC is, has the ability to come together and make decisions, appropriately. But we have to remember, OPEC's not it's not really in their best interest to do much here. I mean, I think if they were to make a major cut, which I don't think anyone's anticipating, then all that's going to do is probably vault prices up pretty quickly and give U.S. producers the opportunity to hedge themselves and keep sustaining themselves. A lot of the Middle Eastern producers, who are low-cost producers themselves, kind of like this lower oil price because it kind of squeezes the U.S. producers a fair amount.
Let's talk about U.S. equities. I understand you're favorably disposed, shall we say, to that area more so than elsewhere.
Well, I'm sending you.
Here's the reality. U.S. equities, I think, in principle, right now. I mean, we're seeing a lot more optimism today than we were, in the last little while, relative to a lot of the dark clouds that we're seeing in Europe and in Japan and other markets. I think U.S. You got the U.S. dollar, you got the strength of the economy that continues to sort of chug along quite well. We really like them, but more than anything else, I think for Canadian investors specifically, I think it's really important. The U.S. represents one of the most important, vast economic markets from an investment perspective. The breadth of sector exposure, the breadth of quality companies, it's a really easy, safe place to invest, and we're a big believer in investing in that type of opportunity. So we're a big fan of that right now, and I think the U.S. economy continues to show optimism in many respects.
We're looking at the Dow 30 here near its all-time high, S&P 500 at another all-time high. How much more upside is left, and could this last another couple of years?
Well, years are a question mark. I mean, look, there's definitely a longer-term caution that we always have to think about. I think, as I said, some of the dark clouds that are out there over Europe and other jurisdictions. And I think ultimately one of the biggest things we look at, if you look at the Dow Jones there, is, you have to look at the sort of quickness of this move. We've had a very big bounce back after some turbulent September and October periods. And one of the things you look at is, let's say, advanced decline line of the Dow Jones. If you see a persistent divergence there, which we've seen in the last couple of weeks, if the advanced decline line doesn't actually start to keep up or catch up, then I think we might be in for a little bit of a pullback long-term in equities. But the way an investor should be thinking about this is you got to look at always buying high-quality, really good businesses, fundamentally strong. As the economy is improving, those businesses will improve, and ultimately you'll never go wrong if you buy those types of quality companies.
A lot of people argue that equity markets for the past 5 years plus have been subsidized essentially by the Fed, by the other central banks. Do you agree with that? And is it continuing?
Absolutely. Yeah, there's no question. I mean, look, we know that we're in a Fed-supported rally. It's a very accommodative market where price to earnings ratios go up when interest rates are low. And the real question is how long are we going to sustain an accommodative environment from the Fed stance? It doesn't mean interest rates being at zero where they are today. Even if we see a 1% environment of interest rates or a 1.5% environment of interest rates, that still is an extremely accommodative environment. Our perspective is we're going to see long-term rates stay low for a meaningful period here, not really moving aggressively over the next couple of years.
So whenever the Fed does start raising rates, presumably incrementally, although it could be different in that environment whenever that happens, do you foresee an orderly transition or not necessarily?
Well, it really comes. So remember, bull markets don't die of old age; they die of usually policy mistakes. And the real question is how does the Fed articulate its long-term plan? And will they start to make mistakes, like, i.e., leaving interest rates low for way too long? And that's been some of the problems we've seen in the past. My concern would be, I think what investors need to always think about is, one, what is inflation looking like? And is the Fed paying enough attention to it as it sort of creeps back into the economy? And are they going to respond to it? And two is, do they start to articulate a plan to exit this accommodative environment? And what is that, an immediate plan, or is that one that takes, sort of ladders its way up over time? And I think the latter, the model, is what we'd like to see. One with starts to think, but I'd like to see the Fed actually raise rates in the shorter term and maybe bring it up to sort of 1% to show that we will start to move in that right direction and over time.
I'm sure they'd love to do it in a laddered, orderly way, but maybe the conditions of the time, who knows, it may not allow them
foresight.
to do that. Yeah.
It's all about foresight. And I think ultimately you're right. I mean, the challenge they face is what is the market going to deem as still accommodative? And I would argue to the market that they have to look at a very low interest rate that is sub 2-3% as extremely accommodative for us to continue to have really great growth and see great and also fight inflation issues long term.
So back to the U.S. equity markets, which sectors do you prefer?
Well, look, I mean, I don't look at it from a sectoral perspective. I look at it from a quality perspective. I think one of the things that you're going to see over the next number of years is that high-quality companies are going to outperform over low-quality companies. We're not in a period where I think low-quality, junky companies are going to win. So I'm a big believer in positioning and quality. And the other thing is I always think that, you always want to buy relatively cheap companies. So companies that are cheaper versus companies that are more expensive, especially when we see an environment like we're in today where price-earnings ratios have increased quite dramatically. And you want to buy always the companies that are cheaper as much as you can within the sectors.
And when you say quality, what are you talking about?
Looking at companies that are fundamentally improving. So when you look at the businesses themselves, are they doing the things that good companies do? Are they, do they have cash flow? Are their earnings and return on assets improving? Are they buying back debt? Are they reducing their share count? Are their liquidity, the balance sheets increasing? These are really important things. If the companies are doing those things, then they'll be able to sustain different economic environments because the business itself is growing. And that's the most important element.
And you want to get them at a good price.
And you want to get them at a cheap price.
Good to see you, Som.
Great to be here.
All right, Som Seif, he's the CEO of Purpose Investments, his regular weekly appearance. Coming up, it's a short trading week south of the border. We'll look at how markets are moving ahead of U.S. Thanksgiving right after this.